Did you know that if you missed even one RMD, you could be staring at a hefty 25% penalty from the IRS? But did you also know that if you catch the mistake within 2 years, you could cut that fine almost in half? In this video, we're going to walk through some of the most common required minimum distribution mistakes, how to avoid them, and the simple steps that you can take to stay on the IRS's good side and out of penalty territory. My name is Zach Morris, and I'm the founder of Paces Ferry Wealth Advisors. So what is the penalty if you miss your RMD? If you miss it altogether, you're subject to a 25% penalty on the entire amount. So that's pretty steep. Now, if you just miscalculated it and you withdraw an amount that's less than your required minimum distribution, you're still on the hook for 25% of the shortfall. But if you take action within the first 2 years, and ideally the sooner the better, the IRS may reduce that penalty to 10%, and in some cases, they may waive it entirely if you fix it quickly and explain the mistake in writing by filing the proper form, which is IRS Form 5329. But let's be honest, you don't want to pay any penalty at all if you can avoid it. I mean, a 10% penalty on $50,000 is $5,000 for no good reason. So let's look at some of the common mistakes and how you could potentially avoid them. So the first mistake is using the wrong IRS table. So there are 3 different tables that you can use to calculate your RMD. The first is the single life table, which is typically used for beneficiaries, specifically inherited IRAs where the original owner died before 2020. So more on that later on. But the next table is the uniform lifetime table, which is the most common table that people use for their own IRAs. So if you're taking an RMD from your own account, this is typically going to be your default table that you choose from. But if your spouse is more than 10 years younger than you and is your sole beneficiary, you get to use the joint life and last survivor table, which is typically results in a smaller RMD. So the next mistake that people make is just not knowing when to start. This can get confusing because the RMD age has changed multiple times. So based on your date of birth, if you're born before July 1st, 1949, and you're already well into this process, your age for required minimum distributions was 70 and a half. Now, if you're born between July 1st, 1949 to December 31st, 1950, your RMD age is 72. If you're born between January 1st, 1951 to December 31st, 1959, it's 73. And if you're born after January 1st, 1960, your required minimum distribution age is 75. So in the year you reach your RMD age, you're going to calculate your distribution based on the balance of your IRA on December 31st of the previous year. So here's where people mess up. Is that if they don't take their required minimum distribution in the year they turn their RMD age, they can wait until April 1st of the following year. However, by delaying it, it can sometimes be out of sight, out of mind, right? And so you get into that next year and you're only thinking about your RMD for that year, and you might forget that you still have to take a required minimum distribution for the previous year, the year that you turned a required minimum distribution age. Now, by delaying, it can also bump you into a higher tax bracket. So it's not always the best strategy. And with any tax strategy, we always recommend that you speak with a tax advisor or CPA before implementing anything. But it's often a better idea to spread those out over 2 years rather than taking all in 1 year, especially if you're not working anymore and you need the money to live. Now, the next mistake that we see, which is all too common, is assuming that someone else is handling it. So out of sight, out of mind, right? Not always a good plan. A lot of people have 401ks scattered across former employers and assume that someone's going to notify them or handle the RMD for them, and that it's really that custodian or that 401k's responsibility to make sure you take your RMD. And that's not the case. Now, the IRS has a rule, Notice 2002-27, that requires custodians and trustees to notify you of your RMD obligation and even calculate it by request. For example, Schwab does this automatically on client statements. But 401k plans aren't subject to the same rule. So some of them may notify you, but they're not required to. So the custodian is only required to send you a letter or include it on your statement, but you have to actually take the action to take the money in order to satisfy your required minimum distribution. Now, the next mistake that's very avoidable is waiting until the end of the year. People often say, I'll take my RMD in December so the account can grow longer, which makes sense until it doesn't. If you're one that has 401ks scattered all over the place and multiple IRAs at multiple custodians, if you wait too long, paperwork delays, especially with the old 401k providers, can potentially push you into the next year. And that's a penalty waiting to happen. Instead, make a plan early in the year. And if you need the money anyway, take 1/12 of your RMD monthly. That keeps it simple and you don't risk forgetting or missing the deadline. And remember, if you're withholding taxes, then the amount that you're taking out, the net amount that you're taking out, might not be the total RMD, right? So if you look at your RMD and you say, I don't need that every month, well, if you're withholding 10 or 15%, the actual amount hitting your checking account every month might be less. So take that into consideration when you decide whether you want to wait till the end of the year or just take it on a monthly basis. Now, this next mistake is also easily avoidable as long as you know where all of your IRAs and 401ks are. And it's forgetting to aggregate all of your required minimum distributions. So you can take a total IRA RMD from just one IRA, but that only works for IRAs. You can't take your 401k RMD from an IRA or vice versa. So if you have multiple 401ks at multiple previous employers, you're going to need to calculate each one separately and follow the rules for that account type. So even if most of your money is in one IRA, don't forget that the old $50,000 IRA or 401k sitting elsewhere still requires a minimum distribution. You've got to include its balance in your total RMD calculation. Now, the last common mistake that I want to talk about is forgetting to take a beneficiary IRA required minimum distribution. Now, this can be very common because sometimes people inherit an IRA and they either forget about it or they wait until it's potentially too late. And also, maybe not as common, but your parent or loved one that left you this IRA could have had it invested in some type of product like an annuity or maybe at a custodian that's not as easy to deal with and you're always calling a 1-800 number. If this is the case, it could take weeks, if not months, to process a required minimum distribution. And it's very important that you start the process early and at least know what that process is. So the other thing that gets tricky is based on the Secure Act 2.0, all of the laws changed in terms of beneficiary IRA required minimum distributions. So if the account owner died before January 1st, 2020, beneficiaries can generally stretch the RMD out over their lifetime using the single life table. However, if they died on or after January 1st, 2020, things changed. Most non-spouse beneficiaries now fall under the 10-year rule, meaning the entire account must be emptied by December 31st of the 10th year after death. If the original account owner had already started RMDs, annual RMDs may still be required in years 1 through 9, and then the total distribution would be required in year 10. So it gets a little confusing. So at the end of the day, RMD rules are nuanced and the penalties are steep, but most of the big mistakes are totally avoidable with a little planning. If you want to avoid that 25% penalty, act quickly and don't assume anyone else is handling it for you. The IRS may forgive mistakes, but only if you fix them and file the proper Form 5329 and request a waiver. My name is Zach Morris, and if you've enjoyed this video today, please go ahead and hit the subscribe button and the notification bell so you can be notified of more videos in the future. Thank you for watching.